Yeah, pause it. Okay. Hello, everyone. Hello, hello. My name is LaShawn Fleming Bruce, and I do go by Sean Speak. Sean Speaks on my platform FYTM Network. This mindset investing class is presented to you by the brand Wall Street, the brand, which is a Facebook group started by Derek. Black Wall Black Wall Street is kind of like what he kind of goes by. But he started the Facebook group, which is basically a group that's with the intent of encouraging us to get into investments, into finance, entrepreneurship, anything sort of regarding business. And so when I got tagged up with him, I kind of wanted to bring sort of the mindset idea. Me and him have had many conversations. And one of the things that I realized about, us is that, it's not that we don't know how to, it's not that we can't get the info or can't learn the information. A lot of times what prevents us from learning the information in the area of business and finance is either fear, lack of knowledge, right? Not knowing that you don't know. And so one of the things that we had talked about is doing a mindset investing class. We have been posting a lot of stuff on the Facebook group, different things to try to give some inspiration to people who are aspiring to be entrepreneurs or investors. I know that I try to post things on different stocks and different things that I learn because I'm a learner. I love to learn. And I'm finally learning where it's not costing me an arm and a leg loans to learn. And as I learn, I like to share. That's what this mindset investing class is all about. Derek did send a sort of a greetings to the class because he was gonna not be here. I did upload it. So if you look in your chat section, you will see a PDF. You can download that PDF. I'm going to read just the first couple of sentences from it, but I'm not going to read the whole thing. He says, greetings, class. I apologize for my absence. Duty has called yet again, but Sean will deliver my portion. First, what do you want from the life you've been given? I was at the exact same point that you may be at today. However, my former thinking and former daily activities were not working for me. Therefore, I formed different daily activities, which became habits and became a lifestyle of positive thinking and positive action. I will not sit here and force anything upon you. We only want to help. In fact, the more people change their thought process, the more value we give to the world. We are all about team building and free thinkers. And so that's greetings from Derek, who, like I say, is the organizer and the mastermind behind the brand, Wall Street, the brand, which is the Facebook group. I see a Zen Fawn V. Hey, Zen Fawn, can you hear us?
Yes.
Okay. And pronounce your name?
Jennifer.
Oh, Jennifer. Okay. Hey, Jennifer. Did you want to be on video, Jennifer, or you just wanted to listen and be able to see me?
Listen.
Okay. All right, that's fine. Are you able to see me though?
Yes, I am able to see you.
Okay, good. Well, we had just really got started, y'all. Jennifer is actually my cousin. Hey, cuz. What's up, cuz?
Hey, cousin. I'm so happy to be here.
Great. All right, and so I had just basically was reading, I was letting them know that, basically this mindset investing class got organized through a Facebook group called Wall Street, the brand, that was created by a guy named Derek. And he sends his apologies for not being able to be on the call, but he is duty called and he had to meet his duty. But I did upload his commentary that he sent. It's uploaded in the chat. So if you go to the group chat, right, you will see a PDF. Are y'all able to see that? Are y'all able to see that?
No.
Okay. Well, it's in your, do you see your chat? Do you see a chat box?
I see the chat.
You do see a chat box?
Yes.
I see a chat box, but I don't see any information in the chat box.
You have to, okay, maybe it'll be delivered to you once you're in. It's in there. Maybe that you don't get it till the end of it. Okay. Do you see when I say hello?
Yeah.
Yes.
Okay. All right. So the document then will be delivered to you once we finish. The document will be delivered and you can be downloaded. But it's in there. If you see my hello, then I'm looking at the PDF in the document. Okay. All right. So this is I want to get. Let's get started. All right. I think this is a great start. The fact that you're on this call lets me know that you're ready to either learn about investment, talk about investment, or get your mind right so that you can be willing to learn about investment and talk about investment. And so what I want to do is I'm going to start off with something a little strange. And if you know me, I can sometimes be a little strange. I'm going to start off talking about something about science, right? Not that I'm a science person, but I'm going to start off with a little bit about science, right? Everybody's heard of matter, right? Matter is anything that can be touched, okay? You probably remember that when you was in high school, science teacher talked about matter. Matter is anything that can be touched, right? And matter is made up of atoms, all right? And atoms are basically made up of neurons, protons, and electrons. All right. Now, what science is beginning to discover is that within the atom, with the neurons, protons, and electrons, is that it's mostly nothing. Meaning, it's literally most of what's in an atom is untouchable. It's not matter. We sort of have been in the mindset that most things was matter because we can touch it. We think that was the majority of what was in something was because we can touch it, that was matter. Well, science is beginning to find that no, most of what is in an atom, which we're made of, is basically nothing, right? And so let me give you an example. All right, so y'all see this dollar bill that I'm holding up? All right, most of us, when we look at this dollar bill, we see this dollar bill because we can touch it, right? We tend to focus on the materiality of this dollar bill. I know I do, right? You want more dollars, you want more coins, right? But what science is beginning to show or discover is that this dollar bill is mostly energy, okay? Not matter, not touchable, right? Even though you can touch it, it's mostly energy. So one of the things that we are beginning to find, or one of the things I think that it will help you with regards to money, is if you change your view of what money is. As long as you view money in only the materiality sense, then you're always going to feel like you've got to make money, go after money, try to get money, right? But when you think of money as an energy sense, then you begin to realize that if money is energy, and then I'm energy, right? Because the same protons, neurons, electrons that make up money make up your body, right? Research it if you don't believe me. The same things that make up the money is making up your body. That means that your body is mostly energy, right? You do know that your body is mostly water, right?
Yeah.
Your body is mostly energy. All right, so what we're going to do is retrain our thinking about money, and we're going to look at money as energy. Say my energetic ability to respond to what I need and want. That's money. Money is no longer the paper, the coins. It's my energetic ability to respond to my needs and my wants. Now, the reason why we know that it's an energetic ability to respond. You're back before 1954, no one thought that you could run a 4-minute mile. It was an impossibility, right? So they thought. Until a man named Roger Bannister ran a 4-minute mile. Now, this was the interesting part about it. No one could do it prior to 1954. Roger Bannister did it in 1954, and then 2 months later, everybody just started to do 4-minute miles, right? Because when you start to exert your energy in response to what it is that you're wanting or needing, you then that's a responsibility. You can then have what it is you're wanting. So as long as we're afraid of money and we think money is over there, as opposed to understanding that money is basically us. This dollar bill did not exist until somebody thought about it. Somebody thought about money. The term money wasn't even used until the 14th century. So if the term money wasn't used before the 14th century, did the people before the 14th century not have the energetic ability to respond to their needs and wants? Of course they did. And they were not bound by money the way we are bound by money. Okay, so that's one of the things that if you just change just a little bit of what you think, your view, your perspective about money, that right there will help a lot, because you won't look at money as having power over you. You'll look at you having power over your money. Okay, and so what that means, like, I'm sorry, so I got a question.
No, I just said wow.
Okay. So once you kind of can, and let me tell you something. Now this takes work, right? To start to think about money as not being material is hard. Okay, because when that bill comes, right, and you need the cash money to pay that bill, you could be like, okay, Sean, where's my energy on this? I need dollars. All right, and I get that, but if you just work on changing your mindset about how you view money and look at money more as energy, it will begin to ease the stress of ever thinking you don't have enough money. You can never not have enough money as long as you are alive, because you are energy. Okay. And you know, a lot of times people don't realize, I think we got like 2.63 trillion volts of electricity in our body. That's just how much power we have. Look it up. Right? We're powerful beings, right? That's electricity, that's energy running through our veins. And so we have no reason to be afraid of a car note or an electricity bill or a mortgage note, right? Because we have the energetic ability to respond to that. And even if we have to make adjustments in our lifestyle to get to where we want, that's perfectly fine, because we have the energetic ability to respond to our wants and our needs. All right. So one thing I would like for you to work on is to gain that new mindset is start to disconnect your thinking about money as material and start to think about money as energy. All right. And then this way you'll have power over your money instead of money having power over you. How is it that a dollar bill that a person no different than you and me created have more power over us than we have over it? Right? So we got to change our thinking about that. All right. So that's one of the things about the mindset portion of investing, is that I want you to really work on not thinking about money in a dominant sense as material, but think about it in a dominant sense as energy. And then think about the fact that you have the energetic ability to respond to what it is that you want and what you need. Just like a Roger Bannister had the energetic ability to run a 4-minute mile when everybody thought that was not even a possibility. Okay. And one of the underlying beliefs that you have to start to have, right, is that you have to believe that human potential is limitless, or at least nearly limitless, because you don't know what you can do until you try to do. Okay. So that's when somebody say something can't be done, that's almost got to be something that you can tune out immediately, because you're like, well, you know what? I never tried it. Maybe it can't be done until I try to do it. Now, once I try to do it and I can't do it, maybe I'll concede that it can't be done. But you don't know until you try. All right. So are we going to work on resisting, or disconnecting our mindset about money from materiality and try to focus it more on energy?
Energy.
If you have any questions on that, anybody, any challenges, any questions, any thoughts? No? All right. All right. So let's get into why. Okay, one more thing. A lot of times people don't want to get into investing. It's because they want to hold on to the money. They want to hold on to the dollar bill. Okay, they want to hold on to it tight because they need it for the next month's bill. And I get it, right? Or they don't want to risk the dollar. They don't want to risk this dollar and then they end up getting a dime. Because then that means they lost 90 cents. Who wants to do that? So they're afraid of risk. One of the things that I need for you to start to challenge yourself on is that investing in yourself is never a risk. It's never a risk to invest in yourself. And when you start to invest in yourself, you gain a confidence that will then allow you to operate in other systems. And remember, the stock market, that is just a system, right? A construct created by people who decided what the rules are. And what this class is to help us to navigate a little bit that system, but also understand that it's just a system, right? It's just dictated by other people's thoughts, right? And it doesn't mean that you can't navigate and understand their system without necessarily understanding every little nuance. You don't have to, I don't hold any Series 6 or Series 7 license. I'm not a stockbroker. I'm none of that, right? If we continue to do these classes, I plan to bring in people who can go in depth more with it. This is sort of an overview, and then this is us learning together, okay? All right, why we should invest. This is why we should invest. Because if we don't start to invest now, we're missing out on opportunities to build wealth without effort, okay? Let me say that again. If we don't start to invest, we're missing out on opportunities to build wealth without effort. And let me explain what I mean by that. I know many of us have our 401ks, our 403bs, our teacher retirements. I get that. That's to the side, right? And I think Derek has been doing some research and he's seen some things where they may change that, right? They may take away those systems, right? So they may take away those retirement opportunities and they take away 401ks, 403bs, or Social Security, or some of those things. You know, they're not going to take away the market, right? Remember, any system that they create and they make adjustments to, they are coming up with the game plans. They're coming up with the rules, okay? So we've got to get into the game and start learning some of the rules so that we can then bend the rules to benefit us. But you don't even get there if you don't have your mindset right and understand that there are no risks if you're betting on yourself, and there are no failures, right? There are experiences that may not necessarily turn out the way you want them to turn out, but there are no failures. And you have to start to change your mindset about that, because if you focus too much on I'm afraid that I may lose it all, I'm afraid that I don't want to take a risk, or I'm afraid that I may fail, then you're never going to really step out and invest and do the research that you need to invest in. All right, Google. Everybody heard of Google, right? Mm-hmm. Anybody on this call hadn't heard of Google? All right, anytime you want something or you want to look for something, you go to www.google.com. Mm-hmm. Right? Now, Google went public on August the 19th, 2004. Okay? In 2005, Google was trading at $90 per share. You heard that? $90 per share. Did y'all hear me?
Yes.
Mm-hmm. $90 per share. Anybody know what Google is trading at right now?
No.
Okay. I'm going to see if I can. Oh, shoot. Y'all can see my screen. Y'all can see me, so I share my screen. Y'all should share my screen. See my screen. So hold on. Let me go to. see. All right. Can you see my screen?
Mhm.
Yeah.
All right. So this is Google. It's the Alphabet Company Inc. is what is the formal name of it. Do you see what it's trading at?
Wow.
Let me use my marker here so you can see. All right, you see where I'm right here? Where the red is?
Yeah.
That's-
Wow.
Google is trading at $1,340.98. Now, what did I tell you Google was trading for when it went public in 2005?
$90. $90.
$90. Now, I don't know about you, but in 2005, I had $90. Let me tell you how I know I had $90. Because I was a weave wearing sister. And I didn't get cheap hair either. I got expensive hair because I didn't want that stuff to kink up. And I paid way more than $90 on a almost every other monthly basis to get my hair done. I had $90. The question isn't, did I not have the money to invest? I didn't have the mindset to invest.
Yeah.
You see what I'm saying?
Wow.
I didn't have the mindset to have been keeping up with what's going on in the world, to know that in 2005, to have the foresight or at least the thought that I would be Googling everything, right? Where is this located? Oh, girl, let me Google it. Well, how do you do this? Well, let me Google it.
Look it up. Yeah.
No, right? But is it that we did not know, or is it that we could have known, but our mindset, our view of life kept us from easy opportunities, right? And what you gotta change, that's why money has to become energy to you, because when it's energy to you, guess what you start to do? You start to attract to that which you want, which is why you're on this call right now, right? I'm sure that they had calls like this, maybe not on Zoom, of course, in 2005, but we were not on it because we didn't have the energy to believe, we didn't have the ability or the mindset to believe we had the energetic ability to attract what we need to meet our wants. So one of the things that I say is you have to change your viewpoint. And I want to use the exact way I wrote, if I had to say what my, what is a greater expression of my financial self? And I say my greater expression would be that my financial self is to be liberated in my ability to meet my wants on the level of necessity I desire, right? My financial self is to be liberated in my ability to meet my wants on the level of necessity I desire, right? And so once you start to have that kind of mindset, now all of a sudden you participate in classes like this and you find out information that's already, this information ain't new, right? It's just that it's being now presented to you and you're open to receive it. So $90 per share in 2005, $1,340.98 in 2019. And I could have gotten into the game with $90. What you say? I could have gotten into the game with $90 and forgot about it. Okay. Are you with me?
Yes.
All right. Okay, so let's talk about Amazon, right? Amazon went public on July 5th, 1994. When Amazon went public in 1997, the stock price was $18. Y'all hear me? $18. Amazon now, you see what Amazon is trading at now?
Wow.
See that? Amazon is trading at $1,752 per share. And you could have gotten in the game for how much?
$18.
$18. And if you would have purchased 5 shares. You see my fingers? 5. 1, 2, 3, 4, 5. 5 shares of Amazon at $18 per share. You'd have spent less than $100. And let's say you would have did it, invested it, and forgotten about it. Ask me how much that stock would have been worth at the end of last year. Just ask me. Say, how much, Sean?
How much, Sean?
$120,000.
Wow.
But now, did either of us have $18 back in 1997?
Yep.
Right? I had $18. I for sure had 100. I could at least bought 5, but I didn't know. I didn't have the mindset. I didn't even have the thinking. I sure didn't have the knowledge. I just didn't know, because guess what? I thought that was for the rich folks. That was for them over there. Right? No more, that is for them over there. That is for the rich folks. No, that is for all of us. It's a system that we get to learn and participate in, and we're going to learn how to bob and weave. We're going to bob in there, play the system, bob out of the system. We're not get stuck in it, okay? Invest. Invest means to expend money with the expectation of achieving a profit, all right? So you want to spend money, invest in something with an expectation of receiving a profit. Now, sometimes the profit, most times we want the profit to be money, okay? We all don't want, nobody wants to invest $1 and lose 50 cents. I get that. But sometimes the profit is experience. Sometimes the profit is learned and added knowledge, all right? So sometimes the profit you make from the investment, just like tonight, you're investing, an hour of your nighttime on a Sunday night for a class like this, right? I'm not going to pay you any money for taking this class, but you're going to get knowledge, and you're going to get an awareness that maybe you didn't have prior to taking the class, okay? And the reason why we want to start to invest on I say a monthly basis, right? I say, you want to, when you get into this investment game, you want to put something into an investment every month. And it doesn't have to be much, y'all. It really doesn't. You can really get in the game for less than $50 a month. When I started investing, I'll never forget, it was probably about 5 years ago. And I'm going to tell you the truth. The only reason why I started investing is because somebody sent a text message to me, and they said, Apple did a stock split. All right. I don't know if you know what a stock split is, but a stock split is basically this. If the stock is trading at $1 per share, a stock split could be 2 for 1, meaning that one stock is going to now split into 2 stocks. And so now, instead of you having to pay $1 for the stock, you're going to pay 50 cents. So basically, they did that stock split, and Apple became affordable. And if you know me, I love my Apple products, right? I love my iPad. I love my iPhone. I just think Apple products are pretty. I know, just keep me on that, but I do. And so there was an opportunity. So I was like, okay. And then in Netflix, I'm a big movie. I like to watch TV, right? I'm a big TV and movie person. And Netflix, I used to order Netflix. Remember when Netflix, you get DVDs in the mail? And I was very, my DVDs in the mail, because I didn't like using Redbox, because I always ended up paying for the movie. And so I decided to invest a few dollars in Netflix. And I think when I first got into Netflix, I think Netflix was trading for $17, $16 a share, something like under $20 a share. But Netflix, I think now is trading almost, $200 and some a share, $300 a share. And I invested in that. I set it up. I think I had $50 going in there a month after that. And I'm gonna tell you, I didn't touch my E-Trade account for probably 2 years after that. And then finally I was like, man, let me go check on it. And I looked over there, I was like, oh, my mouth was wide. It's like, man, had I been, had the mindset, I would have continued to invest in the same stocks. month after month using that $50 that was being deposited in there every month. All right. So you got to get in the game. You got to put this at the forefront, because this is how you learn their system. And you don't have to spend a whole lot of money to get in the game to learn their system. All right. Okay. So that's investing. We want to invest. All right. This is the thing. Up to this point, I think many of us, including myself, we've been living in what I call survival mode, right? We just want to make ends meet. We want to just have enough, right? That's survival mode. And we've been living in a survival mode financially. I think it's time for us to move from survival mode financially to creative mode financially, right? Because when you're in creative mode financially, you're in more control. When you're survival mode, you're at the mercy of somebody else, okay? All right, investing gives you an opportunity to stop living in survival mode, all right? And there's different things that you can invest in. You can invest in the stock market, the New York Stock Exchange, the Dow. You can invest in real estate. You can invest in startups. And as we continue to do these classes, we will pick a subject and focus just more on those subjects, right? So today we kind of just gonna do a little bit of an overview. I am gonna kind of take you a little deep with price earning ratios as our one thing to really learn from a terminology standpoint. Now, securities. When you buy into a company, you're buying securities as a certificate of ownership. You usually buy a common stock, although there's a such thing as preferred stock. And when you buy into a company, you're basically buying its equity. It's ownership into a business. All right. So what I'm going to do is, I hate that I'm going to share my screen so I can pull it up so y'all can see, since y'all can't. Let me stop sharing that, and then let me go back, and then let me pull up. Let's do this sheet. Oh no, not that one, not that one. This one. Hold on, y'all. Let me pull up. Not that one. Where is it? Okay, this is it. All right. Can y'all see that?
Mm-hmm.
Okay, I can see that. All right. So let's go through. So price earnings ratio, and I'm going to provide you with this worksheet or this notes. I'm gonna upload it to the chat. You just have to make sure you download it. And if you don't get it, if you're not able to download it, just let me know and I'll send it via email. All right. So price earnings ratio, right? So now you understand that there's value, there's benefit to getting into the stock game, right? There's benefit to sort of at least kind of trying to keep up with sort of where the market is going. And but how do I choose a stock, right? So price earnings ratio is one way a lot of people choose stocks, although it's not the only way, and it should not be the only factor, but it is an important factor. So we're going to start with that. All right. A PE ratio is what we call price to earnings ratio. All right. The price of the stock does not equal value of a stock. So just because a stock is worth $10, $20, or $1,000, that doesn't mean that that's the value of the stock. So that doesn't mean that, the stock is actually worth or have the value of the price of the actual stock. The price of the stock is just the cost. This is the cost to buy into this particular business. Earnings is the profit a company makes on a quarterly, a yearly basis. All right. Usually when they do the PE ratio, they calculate it on the quarterly basis. but it's just basically, you know, you're taking the business's yearly earnings or their profit to be able to determine what the earnings are. Shares. Shares represent your ownership of the profits of a company. So that's your equity, which talked about that. All right, earnings per share. So here's an example. If company X's profit is $4 for that year, and you take $4 and divide it by its outstanding shares, and let's say they have 4 outstanding shares. So the company's profit is $4 and they have 4 outstanding shares, okay? The earnings per share for that stock is $1. So that $1 is the basis of value. Now, in order to get to the PE ratio, you have to know what the earnings per share. Now, let me just throw this out here. You never have to do these calculations, okay? When I go back to the MarketWatch site, I'll show you that all of these numbers, they're given to you already, okay? I'm just going to kind of give you an idea of how to understand it. Right.
Sean, why did you use what does it mean for an outstanding share
An
versus just a
outstanding
share?
Okay. So for instance, a company, when it's formed, a company can have, let's say, 1,000 shares, right? But they only put on the marketplace for people to buy 500 shares. So there's only 500 shares on the marketplace that are trading on any given day. Okay, so that's why it's outstanding. Meaning it's somebody out, the company it's out there in the marketplace being traded.
Got it.
Okay, so it's outstanding. All right, so it has to be outstanding because sometimes the company can have shares that they haven't released yet to the market. Okay. All right. So let's say on the market, company X's shares are trading at $10 a share. Okay. Now, if you remember, you can always go to MarketWatch or Google Finance or some other service for the price of the stock. So it's very easy to find the price of the stock, like I just showed you with Amazon and Google. All right. So if the price of the stock, if company X's shares is trading at $10, that's the price of the stock. And I already told you what the earnings per share was, which was $1. So if I take the $10 and divide it by $1, the price earnings ratio is $10. Okay, so that's a price earnings ratio of $10. All right, and when I go back, we're gonna go a little further. It'll kind of sort of hopefully sink in a little bit. But let me give you a little bit more terminology here. Market capitalization. This is basically just the number of shares outstanding multiplied by the share price per stock. Nothing fancy about this, right? So when you go, and I'm gonna show you this when we go back onto MarketWatch. So market capitalization is just the number of shares that a company has out in the marketplace multiplied by whatever that stock price is per stock. Okay. Now, capital structure. Capital structure is how a company finances its assets, right? When you want to start a company, you always have to think about, okay, now how am I going to finance this company? Am I going to issue stocks? Am I going to take out loans? All right. So capital structure is basically how a company finances its business assets. They can do it through equity, which is stocks, debts, which are loans, or some hybrid security, like a convertible debt or something like that, which is a hybrid between a debt and a loan. I mean, a debt and a stock, right? So capital structure. So when a company says that they're going public, right? Or if a company says that they're doing crowdfunding, basically what they're trying to do is finance their assets, right? By giving equitable stake to people, or giving out, or getting money in exchange for having to pay a debt back, right? That's the capital structure of a company. Now, some companies that are public, that are trading, they pay what's called a dividend. Have you ever heard of a dividend? Right? A dividend is a payment made by a company to its equity holders, and it's usually distributed from profits as cash. Now, sometimes they can do a dividend and give you additional shares, all right? But a lot of times it's the distribution of profits in cash. So basically, when a company pays a dividend, it is basically saying, hey, shareholders, if we, the company, make a surplus in profits, instead of reinvesting all that money back into the business, we will give our dear shareholders a portion of the profits. That is a dividend payment, okay? Now, when you are paid a dividend, that is taxable, okay? Just IE right there, all right? And it's also best to probably invest the dividend either back into the company that paid the dividend or utilize that dividend to buy some other security, okay? All right, so what is a fair price earnings ratio? So when you're choosing these stocks, right, we're new at this, right? We're new, we're babies in learning the construct of the stock market, right? And so what did I do? As you know, I said, you know what, who would I want to model my investment life after? And it would be nobody other than Warren Buffett, right?
Mm-hmm.
One of the best equity, investment people out there, right?
Mm-hmm.
And Warren Buffett learned from Benjamin Graham. So two good people to sort of kind of go look their stuff up, YouTube them, read some of their books or whatever. But Benjamin Graham, he has a book called The Intelligent Investor, okay? And he has this value method, right, that he uses, and Warren Buffett adopted it in his investment strategies over the years of investing. And what Graham is basically saying is that when you buy a stock, you want to buy a stock that has potential to have increased value, right? So that means that you don't want to overpay for the stock, all right? And under Graham's sort of value method, you look at the price earnings ratio. It's not the only factor, it's just an important factor. When you're looking at a stock, you want to look at whether or not a company is making money, what their revenue is, what their debt is, so it's, what the market is, kind of what's going on in the market that the company is in. But so this is not the only thing that you're going to look at, but this is where we're going to start. All right. According to Graham, all right, if the price earnings ratio is less than or equal to 10, the stock is what we call underpriced. If the price earnings ratio is 15, that's what we call a fairly priced stock, okay? If a price earnings ratio is greater than or equal to 20, that's what we call an overpriced stock. If the price earnings ratio is greater than or equal to 30, that's what we call an extreme bubble. Now, if you see over here, I basically put here, if it's underpriced or fairly priced, I put IV. According to Benjamin Graham, he said intelligent investors try to keep their investments within these two ranges, right? The underpriced or the fairly priced stock. Because there's
no, I don't. Hold on, Sunshine. I'm not seeing. I just see your file.
Your file. That's all I see. Also.
Oh, y'all don't see all the stuff that I just was reading?
No, I thought you just.
I thought you were just talking.
Yeah.
Okay, hold on. Let me go back.
I thought you was coming off the top of your head.
No, I was showing y'all something. Hold on, let me try to go back.
I'm still up here taking notes because I'm like.
Let's go here. So you still don't see that?
Now we see a Word document.
It's a Word document. You see it now?
Yeah.
Yeah.
Okay. All right. Okay, so everything I said came off of here, and I'm going to provide you with this. So I wasn't going too fast, but you'll have this document to kind of go back over.
Okay.
let me go back to, all right, so let's go back to Graham's value method, right? So you buy a stock, you want to buy a stock based upon value potential, all right? So if the price earnings ratio is under 10 or under 15, according to Benjamin Graham, and Warren Buffett follows this model as well, the intelligent investor definitely want to jump on those stocks, assuming all other factors make sense to invest in that stock. All right. If the price earnings ratio is 20 or more, right, then that's what we call a stock that's either overpriced or within the extreme low. All right. According to Graham, those types of stock investments are for the speculative investor. Right now, given what we are, I'm just fair, transparent with you. I kind of fall in between both of them. Right. Sometimes I choose a stock and I'm not gonna lie, I go straight off a gut. It's like I have this belief or this vision that I see something occurring in 5 or 10 years, and I'm betting on that 5 or 10 years from there, even if I'm in the speculative, range. But then, of course, I try to buy stocks that fall into the intelligent investor range because I admire a Warren Buffett and a Benjamin Graham and a Charlie Munger who are intelligent, are great investors. Okay, and so I'm gonna give some examples. So this will come a little bit clearer as we go to the examples. All right. So average priced markets, when a price of a stock is equal to value of the investment. Overpriced markets, when the price of the stock is overpriced compared to the value. A lot of times what causes a stock to be overpriced is when people become so optimistic about the future earnings, right? Remember the stock, the tech market sort of crashed back in, when it was 1999, 2000, 2003 or something like that, where all those tech companies went under. I can't remember what year that was. Well, that's one of those overpriced markets where they were trading these stocks for this ridiculous amount of money, and a lot of these tech companies weren't even earning any revenue. Okay, that's what we call an overpriced market. An underpriced market is when price of a stock is underpriced compared to value. Now, this is when the stock is less than value because, let's say, people believe that that particular market or that industry is going to go out of style or out of business in the future, or the earnings are not going to, even though the earnings are okay, they're not going to go down in the future. And so that's when you have an underpriced market, when the public sort of bet against a particular company or a particular market. All right. And so you want to be able to kind of look. That's why I really kind of doing a little bit of research, reading. Not that you got to spend a whole lot of time, but if you're if you're into tech companies, you might want to kind of keep up with the tech market. If you're into, real estate, you kind of want to maybe just kind of read an article, or so once or twice a week, just to kind of have an idea of what's going on in the marketplace. All right, so let's give it some examples so we can kind of really have an understanding of price earnings ratio. Okay, y'all can still see my screen, right?
Yes.
Okay, let's look at Amazon. Amazon, okay, so in order to get into Amazon, to become an equity stakeholder or shareholder in Amazon, you have to pay $1,750.60 per share for one share to claim a right to $22.59, which is the earnings per share for Amazon. Okay, I want to make sure you understand that. All right, in order to claim a right to Amazon's earnings, right, you have to buy one stock, and that stock is going to cost you $1,750.60. And that gives you a right to $22.59 of their earnings. So basically what that means if you take the entire earnings pie, right, and let's say the entire earnings pie is $1 billion, right? And you own one stock, right, that you paid $1,750.60 for. That means that one stock bought you a claim of $22.59 of the $1 billion in earnings. Are you following me?
Mm-hmm.
Okay. The price earnings ratio for Amazon on today is 77.60. Under the Graham value model, is Amazon fairly priced, underpriced, overly priced, or extreme bubble?
Yeah, it depends.
So I don't remember your definition of extreme bubble, and
Let's go back.
see that
Let's
you
go
have
back.
it there, but
I got it there, but
it's
let's go
definitely
back.
overly
Let's go back.
overly.
All right, do you see that?
Oh, gotcha.
Mhm.
Okay.
So it's definitely PE ratio greater than or.
Extreme.
Extreme bubble. Amazon's was 77.60 was their PE ratio. So they're what? Extreme bubble. So what
Because
Warren
it's
would say,
over the 30, right?
over the 30 is extreme bubble, meaning according to the Graham value model of value stock, investing in stocks based on value, Amazon is a extreme risk because Amazon is more than overpriced. It's about the pop, right? So now let's not get this twisted. I'm sure that Warren Buffett owns Amazon stock, but he probably did not buy it now. He bought it back when it was $18 a share or $90 a share. Okay. All right.
So in this situation, would someone be looking to, at some point kind of trying to decide, do I ride it out to see if it's going to go higher, or do I go on and cash out so that so that they can capitalize on their earnings?
Yeah, it just depends upon what price that you pay
The
when you
risk
got into the
factor.
game. Yeah.
Yeah, and how much risk you want to.
Exactly.
Okay.
Like if I would have gotten into Amazon back when it was what I said, $18 a share, I think that was Amazon. If I would have got into Amazon when it was $18 a share and is now trading at $17.50, and let's say I'm a little squeamish, right? I'm like, Amazon is great and I love it and all, but remember you got Shopify coming. Shopify is Amazon's. That's gonna be like the Walmart to the Kmart, the Target to the Walmart. Shopify is supposed to be. So I'd probably be squeamish. I'd probably be like, let me just cash out. Let me go try to find me another, Amazon in the making or something like that. But if I'm adventurous, I might just say, hey, maybe Amazon will start trading for 3,000-4,000. You never know, right? Amazon don't seem like it's going to be, losing any steam anytime soon. So this is where this is why your mindset is important, because you always got to trust who first? Yourself. Okay. You always got to trust yourself first. You can do all of your objective data observation and reading, right? But at the end of the day, you got to decide whether or not it's a good investment for you based upon the data that you feel you need to look at before making a decision. Okay. And you may not necessarily need to look at as much data as the next person. Okay. All right, so let's look at Apple. I got several examples just so because understanding this is sort of a really good start. All right, Apple has an earnings per share or EPS of $11.85 and trades at $267.48 per share. So you're paying $267.48 per share for a claim of $11.85 of its earnings. So if Apple is, let's say their earnings for 2019 is $1 trillion, your one stock price give you a claim of right to $11.85 of that $1 trillion.
Oh, no.
Right? Now, the price earnings ratio of Apple is 22.84. Is that underpriced, fairly priced, overpriced, or extreme bubble?
Yeah, is that extreme?
It's not
I
extreme.
think it's fairly. I think stream is 30 and over. So I
Oh,
think
that's right. That's
fairly,
right.
yeah, it's right under the extreme. So it's whatever is under the extreme, Sean. What was that?
Overpriced.
Overpriced, yeah.
Now, does that mean you should not invest in Apple or Google or Amazon? Not necessarily, because you got to look at what's going on with the companies, right? Look at the business, what's going on. Look at their revenue, look at their debt. So you have to look at a lot of different factors. But if we were just going off of Graham's value method, then Apple would probably not be a company
Good. Yeah.
to invest in right now. But remember now, there are whispers in the marketplace that a recession is coming, right? And the reason why it's great that you're taking a class like this is because it's got your antennas up, right? So if you start hearing recession, we're in a recession, you're going to be like, okay, well, let me go and see what Apple trading in now. Let me go and see what Google is trading in now, right? Because those prices may then be on sale, okay?
Yes.
And then if you can get them when they're on sale and forget about them, be patient, right? An intelligent investor is a patient investor. You don't think you're going to make all your money today or tomorrow or next year. You buy it and forget about it, okay? All right, so let's look at Home Depot. Home Depot has an earnings per share of $10.06 and trades at $214.28 per share. All right, and their price earnings ratio is 21.3. But Home Depot pays a dividend of $5.44 per share. So that means I don't know how Home Depot actually pays out its dividend, if it does it quarterly or yearly, but that means if you own 2 shares of Home Depot at the time it pays dividends, you would get $10.88 just because you're an owner of 2 shares of stock. You understand that?
So let me just clarify based on what you said. So if I'm an owner of 2 shares of stock with Home Depot, then that means I have $418 and whatever change invested in that stock.
Yes, ma'am. And keep going.
Okay.
Wait a minute, keep going though. And that
Okay.
means because Home Depot pays a dividend, every time Home Depot pays that dividend, you will get
Extra $10.
$10.88 put into your account.
Okay.
You got it?
Yeah.
Got
So
it.
companies that pay dividends, that's a good thing to have, because that's just free money for ownership. Okay?
Okay.
That's just free money for ownership. And so what you want, when they pay that dividend, you can then take that same, $5.44 and invest it right back into the company or buy some other stock with it. Okay. Let's look at Starbucks. I try to pull some of our favorites. Starbucks trades at $86.32. It has a price earnings ratio of 29.5. Is that's an overpriced, that's almost an extreme bubble stock, real close to it, right?
Yeah.
But am I telling you not to invest in Starbucks?
No.
Right? That's why you can't just look at the price earnings ratio by itself. It's a start, but you can't just look at it by itself. Now let's look at Beyond, trades at $2.51 per share. It has a earnings per share of 33 cents. So basically you get a claim of right of earnings of 33 cents for every 1 share you own. And the share only costs $2.51. And it pays a dividend of 24 cents per share.
Hmm.
And it has a price earnings ratio of 7.5. Is that underpriced, fairly priced, overpriced, or extreme bubble?
It's either fairly or under.
It's underpriced. So that means that that's a stock, according to the Graham model, that's a value stock for you to buy, because under his model, that stock will actually eventually increase in value, assuming, of course, all other factors support investing in that company. Okay? Because it's got a 7.5 price earnings ratio. So it's underpriced. It's undervalued. And it pays a 24 cents dividend per share. It only costs $2.51 per share. And you're earning 33 cents in earnings per share. So even though that stock is trading at a very low price per share, it's not a bad deal, right? Don't let the pennies, the nickels and the dimes fool you. It can add up over time.
So Sean, explain again earnings per share.
Earnings per share is basically the claim of, okay, so when you buy stock, that stock buys you a claim to the earnings of a company, all right? And so if a company has, let's say, $4 in earnings for the year, and it has 4 stocks outstanding, then if I take the earnings—
Hold on. Does earnings equal profit? Is that synonymous?
Earnings equal profit, yes. It's synonymous with some adjustments, but basically, from a basic standpoint, yes, earnings is profit.
Okay.
Earnings is profit.
Okay, now I understand.
Okay. All right. So let's go Microsoft. Microsoft is one of Eric's favorite stocks, and it's becoming a fast favorite of mine as well. This is the stock. I don't know if you remember, he posted something on Wall Street that he made $70 while he was asleep. And it was because of Microsoft. Microsoft saw his stock in Microsoft jumped up enough that he made $70 just while he was in the bed sleep at night. Now, Microsoft's PE ratio is 28.6. Right? So that would be considered an overpriced stock based upon that price earnings ratio. Got that?
Mm-hmm.
All right. Let's look at electronic arts. Y'all heard of electronics, esports, right?
Yeah.
This is one of the, this is an esport company, Electronic Arts. Electronic Arts is trading at $103.23. It has an earnings per share of $9.19 with a price earnings ratio of 11.2. This would be considered an underpriced stock, and you should invest in it, assuming all other factors support your reason to invest in it. But based upon the Graham model of just for price earnings ratio, this is a value stock, right? So now you got to look at Electronic Arts. Okay, what industry? Okay, they're in esports. Where do I think esports is going to be in 5 years, 10 years, right? What is their, let me go look at their profits and see what they're making. Let me see what their debt is. You know what? I think this is a stock worth investing in. Okay. All right. So what I want to do is let me go down to this one. You have to, the reason why you have to do a little bit of research, right? A little bit of reading is because let's look at Microsoft. Now I told you Microsoft under the Graham model is an overpriced, almost extreme bubble stock. But Microsoft this year just won a $10 billion contract with the government. Right? So that means they got revenue coming. $10 billion, and that's just one contract. That's not even counting all the other Microsoft stuff we all use, the revenue from that. So that may be a reason, even though under Graham's model, it may be considered an overpriced stock. This may be the reason to still go with your gut and buy Amazon. All right? Not Amazon, I'm sorry, Microsoft stock. Okay? And then I look at Amazon. The headline reads, Amazon clobbered after a miss on the bottom line and soft guidance. Basically what they're saying is that Amazon's, I guess their revenue expectation, I think for quarter of 2020 is going to be less than what the street is saying they thought it was going to be, and because of it took a ding on the stock. I think their stock plunged 9%, all because the street wanted them to make 87.4 billion. They're estimating that they're going to make fourth quarter between 80 and 86 billion. So this is how emotions can cause a stock to go up and down, right? This is what I want you to, if you don't remember anything that I say, no one can absolutely predict the market, right? Mm-hmm. There is no crystal ball to this, right? What you got to do is you got to do a lot of, following people who sort of have demonstrated a good record of investment. Then you also got, on top of that, you got to go with what your gut is after you've done your evaluation. All right, so one thing I want to do before we close out is I want to take us on a little assignment. Let me open up this one, and then we'll taking questions. All right, Twitter. All right. What is Twitter's ticker symbol? Does anybody know?
The little bird? I don't know.
Okay, when I changed the screen, were y'all able to, are y'all seeing Market Watch now?
No.
No.
What do y'all see? Y'all still see the Twitter?
Yeah, Twitter example.
The Twitter example? Okay, so that means I have, okay, I'm not ready to share multiple. Okay, hold on. I'll just work off my sheet. All right. You see Market Watch now, right?
Yes.
All right.
Mm-hmm.
All right. So all right, so let's go here. Just so when you go, you can go to Market Watch. You can go to let me just, I think this is something that Derek was supposed to actually go over. Okay, I would assume all of you have, oh, sorry. Can y'all see the Market Watch? Do y'all see Twitter?
Yeah.
Okay. You see, okay. All right, so let me just go through here, and then we'll talk about how to start a brokerage, just in case you don't have one. All right, so Twitter. All right, the ticker symbol, right? When you're sort of watching the news, and at the bottom they'll have these little acronyms at the bottom of the screen. Those are what we call the ticker symbol. Twitter Inc. is the name of the company. The stock ticker symbol is Twitter, TWTR. Okay. Right here is the price of the stock, $30.19.
Mm-hmm.
Okay. And it's telling you here this is the industry, it's in the technology industry. All right. Price earnings ratio. Remember I said you never have to calculate these things. You never have to calculate. All right, that's the price earnings ratio. Twitter is 14.75. According to the Graham's value model, Twitter is a fairly priced stock, which means it's assuming other factors make sense, it's worth investing in. Its earnings per share is $2.05. Right?
Mm-hmm.
That's where it ranks. You see, all the information is right here. You don't have to really do any calculating. All right. If you purchased one stock of Twitter, what is your claim to Twitter's yearly income for this equity stake of one stock in Twitter? Anybody can tell me?
The $2?
$2 and very good. It's not a trick. It's not a trick question. Even though I tried to throw it out, it's not a trick. I already told you. $2.05.
Mm-hmm.
Right. All right. Now, under Graham's value investing model, is this stock underpriced, fairly priced, overpriced, or extreme bubble?
Fairly priced.
Fairly priced. All right. And let's see, what is this company's market capitalization?
23 is 44. Is that billion?
Billion. 23.4 billion. All right. Now that you know some basic things about Twitter, you know it's got a price earnings ratio of 14.75. It's got an earnings per share of $2.05. It's got a market cap of 23.44 billion, right? And it's trading at $30.19 per share, right? And let's assume all other factors like the revenue is good, don't have much debt, other factors that you would take into consideration in determining value are all favorable. What is your feeling about Twitter's futures earning abilities?
So just their earning ability. So I think about how much Twitter is in the political realm right now.
Mm-hmm.
And because it's in the political space and it's very relevant right now, that's just kind of one indicator that to me says that its earnings potential is possibly could be increasing or at least stabilizing because of the influence that it has.
Okay, so your feeling is that because of Twitter's influence, it's not going anywhere no time soon.
Not going down. Now,
not going down. Okay.
At this, you know what I'm saying? But, things can happen, like the CEO could die or, there's certain things that so, especially with social media in that regard, that it could make it dip for a little bit.
Mm-hmm.
But I don't even know that there's a talk of another platform similar to Twitter opening up.
But not for Twitter. There's another platform called TikTok, but it's more of a
video upload. That's kind of a YouTube. They're in the YouTube space.
Yeah. So, okay. So, but the reason why I asked about your feeling, right, is because I want us to begin to become more super sentient, meaning we've got to let our feelings sort of guide us. We can do all of the objective data, observation, and you can do the reading.
Gotcha.
Right? But at
what
the
does my
end of the
gut
day,
say?
Huh?
So you're saying, what does my gut say? And guts aren't thoughts. Yeah, yeah.
Exactly. I'm not saying go with that first. I'm saying you do all of the objective stuff. You do all of what you can do. Let me look at the price earnings ratio. Let me look at the earnings per share. Let me look at the financials. Let me look at the, all of the different things that I can, that I can look at and interpret as best I can, right? So it looked like sales revenue on Twitter in 2014 was 1.4 billion. In 2015 it was 2.2 billion. 2016 it was 2.53 billion. In 2017 it was 2.44 billion. In 2018 it was 3.04 billion. So what do I see? I see that there was almost a 100% increase from 14 to 15. A very slight increase from 2015 to 2016, a decrease from 2016 to 2017, a resurge of 25% almost from 2017 to 2018. I can look at all of that stuff, but what does that really tell me? that tells me to a certain extent, I don't know. I don't know what it's going to do,
You stop coming.
right?
No, she did.
So you have to, so at the end of the day, I can look at that and I can make an informed guess based upon the data I've reviewed. But at the end of the day, what do I have to rely on mainly in making the decision to invest in Twitter?
Your intuition.
My intuition, my feeling, my gut, you know, how I interpret this data, right? Because somebody else will say, no, you know what I see based on this is that, you know what, they're gonna decline in 2020. They may hold steady in 2020 because of what Sharita said, because of the political influence. Okay. All right. So with all of that being said, any questions for me?
So when I hear people saying that I lost everything, what does that happen? That means that it crashed?
Okay, so let's say, for instance, let's say that there is a recession. People keep saying a recession is coming, right?
Mhm.
And so let's say a recession comes in 2021, all right? And let's say you didn't spend $100,000 buying Amazon stock,
Uh-huh.
right? And Amazon just takes a nosedive, right? Like
Okay.
those just, you know, he just messes up and just takes a nosedive, right? And it goes down to $5 a share. So if you paid $1,700 a share in 2019, and now it's worth $5 a share, then you have lost, right?
Yes.
But what you cannot do is sell your stock unless you don't think
It's going to go back up.
that it's gonna go back up. What
Okay.
happens to most people, scared investors are ones who, when the market go down, they then go pull everything out because they're running scared. And guess what they're trying to do? Hold on to the materiality of money.
Okay.
You
Yeah.
know from this class that money is what?
Energy.
Energy.
Energy, right? And we're in control of the energy. Money isn't in control of us. So we're going to make informed decisions. So if the market go down and we like, you know what? Amazon going to recoup this. You know, I'm going to go do my research. I'm going to go look. You know, Bezos he took his meds today. He's good. You know what? I'm going to keep my stock right there. And then
It's kind of make me think about like the oil and gas industry.
Mm-hmm.
You know, sometimes, you know, it goes down and then it goes up. So
yep. Down, up, down, up.
Yep.
Right.
And that's very similar with the real estate market. That's very similar with, because I lost a lot. I didn't lose. My retirement went down significantly between 2008 and let's just say 2013.
Mm-hmm.
And so, but I knew when I started back in my 20s, when I was putting a little bit in each time, they said you're old enough to ride out the waves. If you kind of invest aggressively, when you do have a wave, throw away the paper when it comes in. Don't look at it anymore.
Yep.
And so that's what I had to do because I didn't lose. Thousands went away. But then when it came back, when the market came back, it came back plus.
Yep. And that's what generally happens. That's why we're, you know, the whole point is so that you not to live in the fear mode and the scare mode.
Yeah.
Right. You can't live there because because remember, it's a system. It's a system that wasn't created by us. Right.
Mm-hmm.
And it's a system that you can't be scared when it has ebbs and flows or, you know, downs and highs and lows. You should expect that.
Yeah.
Right.
Yeah.
That's why everything, you know, you say, okay, you know what? I got $100 going into my E-Trade account or my Robinhood account. I got that going over here. I got $50 going into my Ameritrade account. And I got $75 going over here to my my stash account. right?
Yeah.
And you know, okay, you know what? I got all of these money going into different places because I got $400 a month that I'm using to invest, to learn how to invest and to try to grow my $400 a month, right?
Yeah.
Because I'm going to waste $400 a month anyway on my hair, on my nails, right? On my eyebrows, right? I'm gonna do all of that. So why not waste $400 to potentially build more? To build what happened with, I think I said Amazon, $120,000. If you would have just invested $100 back in 2007, you see what I'm saying? Because when we invest, we're not gonna invest our mortgage payment. We're just going to make sure that we don't have a mortgage payment that prevent us from investing.
Yeah.
You see what I'm saying? We're not gonna invest our car note payment. We're just going to make sure we have a car note payment that doesn't prevent us from investing. Because we're not going to miss out on opportunities like that, right? Not if you stick around with the Wall Street, the brand, because that's something I'm very committed to, is trying to stay up with the reading and stay up with kind of what's going on and posting that, and saying, hey, this is what I'm hearing, this is what I'm reading, this is what I'm seeing. And as you get into it, you'll start doing it too, because once you start to understand the terminology a little bit, when you hear things, it's gonna start making more sense to you. And you'll be like, you know what, man, I need to jump on that. Okay, so if you're wanting to, there's many mobile investing apps. I know that I have posted, I think like a how to do this on the site, but it's very easy. You can go to, there's Robinhood. Robinhood is one of the ones I got. I'll be transparent. I have a Robinhood account and I have 2 E-Trade accounts. But Acorn is one, Stash is one, Personal Capital, Stocklight. These are all sort of mobile investing apps. A lot of these apps do not charge for trades anymore. I think I had posted on a group site that Robinhood sort of came in and changed the game, because Robinhood wasn't charging you to trade. E-Trade then decided that they were no longer going to charge you. And I think E-Trade used to charge $5.99, I believe, per trade. Now they don't charge you at all. And all you have to do is just download these apps. All you have to do is download these apps and set it up to your bank account, where you have like a $50 automatic withdrawal going straight to your account. I even set my mom up with one. I was like, look, it makes no sense. Put $50, $25 a month. Just put it in there, and every couple of months, if there's a stock that you want, we'll go in and buy you that stock, right? And remember, you can't say, well, one stock, what is one stock gonna do? That's no money. I'm not gonna be able to get no money. Well, what did $18 for Amazon stock get you if you would have just bought it and held on to it?
Yeah.
$120,000, right? So that's how you have to start look at it. So, definitely download the app, set up your account. I say get started with $50 or less just to get started. And then once you decide what stock you want to start off with and you got enough to buy that stock, buy that one stock. Like I'm gonna be honest with you. I wish I could go back 5 years and I would have just bought Netflix stock. I'd probably be freaking rich right now. Right?
Yeah.
I didn't buy enough. I just bought it. I forgot about it. I did the right thing. I bought it and forgot about it, but I should have bought it, forgot about it, and rebought it every month. Right? Because it'll take 5 seconds. You get on your app, you say, oh, EA, parts, you put in the EA, the ticker symbol, then you put buy, and then they say how many shares, you say 1. Boom, it automatically takes it out your account, because you already got the money coming from your bank account to the
it's already in there.
app. So the money is already there. You're just tying that money to a particular stock, and boom, you forget about it. Okay, so it's not difficult. It's not afraid. It's nothing to be afraid of. time for us to raise our frequency when it comes to money. And the only way we can do that is to stop looking at money as just being paper. This is somebody's, this dollar bill was in the mind of a man or a woman. And you're just now seeing it in the manifestation form, right? So there's nothing to be afraid of when it comes to the dollar bill, right? Nothing to be afraid of when it's coming to money, because you have the energetic ability to respond to your needs and your wants. All right, let me take that off of there. Any questions for me, y'all?
No.
No?
Yes, I have tons of questions, but I'll let everybody else get off the call.
But I'm just gonna make a comment. You need to set up a time where I can come to your house and bring my dollars, and that's all I'm gonna say.
You're so silly. Bring your
No,
dollars.
I'm serious. I'm serious.
What you mean, bring your dollars though?
I'm gonna bring
Let's
my
stop recording.
phone.
I'm gonna take us off recording. Well, first of all, I want to thank each and every one of you that participated in the class. We are going to do it again, and I hope we have some more people to join us. But you know what? I don't care if I'm teaching a one or teaching myself. I'm always excited when I take my understanding and my knowledge level to another level, because I then begin to see how pieces of the different puzzles of life fit together. And I become less afraid of things that I used to be afraid of. And once you can remove the fear, you begin to realize you really can design the life the way that you want to design your life. And with that being said, that will conclude our Mindset Investing 101 class. I thank each of you for participating, and I'm going to stop recording now.